Good afternoon, salam, namaste. Those who have gone, they'll not get any food, I can promise you. I'm here with some amazing names in the fund market. If I look at the collective experience of my fellow panelists, we are looking at experience of over 100, 150 man years. We're looking at over 5,000 companies they have looked and invested close to $1 billion in those companies. So we are seriously looking at a very, very smart, intelligent capital and ideas they have. So with that, let me just explain a little bit about, and yes, there are two very important announcements which I will share after the panel. Those who will wait till the end of the panel, those who will hold their hunger, will have some good takeaway that might leave them richer as well and also more informed if you hold on to your hunger pangs for a little bit longer. And I apologize to all my fellow panelists. This is the dynamic nature of our industry. Expect the unexpected and be ready to know whether, whatever, brave the delays. So once more, apologies on behalf of only me and me. So startup funding. We are here today to find out why the startup funding has not really taken off in agri and food as it should, because 68% of Indians are involved in agri and food. It is the lifeblood of Indian economy or Indian population, but we have 115 or 120 unicorns which are more than $1 billion in valuation, but we have probably, other than leaving aside the grocery or deliveries, not even a single unicorn. Why are we suffering from a winter funding, or is it just a lull or a chilly day? Why is it that international investors are shying away from investing in agri-food? Even the domestic investors are not that gung-ho. Where are the new opportunities and ideas where we are looking to invest? And what mistakes a startup should avoid when they go to funding? So with that, I will start with Jinesh from Omnivore. Omnivore has done amazing investments. They were probably pioneers in agri-food investment. So a little bit about your journey and where do you see the bright spots and the mistakes which a startup should not commit when they come for funding to you.
Thanks Sudhakar, and thanks Globoil for having me here. As a background, we are a food and agri startup fund. We currently investing from our third fund. We invest into Series A, pre-seed or seed companies. So that is the first institutional check we put in. We've been doing this for last 10, 12 years. I've done some 40, 45 investments. Hopefully got some exits, and hopefully a few of them will soon become unicorns in next year or two. I mean, that's the plan. So look, the question about is that what to start, why agri-tech is not really gone the way it should have been gone, right? I mean, look, agri-tech as an ecosystem globally has started around 10, 12 years ago, right? I mean, biologically we are maybe 15 years behind the VC investments. So expecting us to get unicorns in the first 10, 12 years of a journey is difficult. It's the last 5, 6 years which are more exciting than the first 5, 6 years. And I think it's just a matter of time we'll see unicorns. We'll see a lot of disruptions happening in it. I mean, we are seeing those early signs, especially in the distribution games where large startups are now competing with companies like Bayer, Monsanto's. I mean, in the distribution space, they have the even larger networks than quite a few startups. I mean, we are seeing startups working on doing more value additions, figuring out a way to work with the government, with the startup ecosystem. And fortunately, we are seeing more and more global capital coming. So it's not that we don't have capital coming in, right? I mean, my fund has most of the global investors. I mean, the DFIs, the sovereign funds, we got fund of funds. They're all global investors coming in. It's happening right now, right? I mean, the winter's going to take time because I think for agri-tech, the ecosystem really started after the demonetization, the geo launch, and the COVID event, right? I mean, all those three things are really helping the agri-tech startups to get the momentum. Today we are in the pace. I think I have got Agam on with me on the panel. I think they've been doing a wonderful job, I think, and we are seeing those things. I think from a VC perspective, look, when an entrepreneur comes to raise capital, we look for simple things, right? Saying, are we coming with the right set of team? I mean, because team is the most important thing. Are we targeting a right target market or TAM, right? Which we want to work into multi-billion-dollar TAM. And hopefully, do we have a moat in terms of technology or technology? That's what we look, right? If the entrepreneur has all those things, I think there is a fair chance if you look seriously at the deals and hopefully make investments. But to say yes for a deal is always tough, right? On an average, we see probably around 8 or 9 deals a week, right? That's what within the team we see. And probably we invest like 6 or 7 transactions in a year. So the ability to say yes is always limited, but hopefully there are many investors coming in and I think you'll see more entrepreneurs getting funded. So that's what I'll put in.
So the TAM, which is total accessible market, is very, very important. And the team, and if you're really solving a large-scale, genuine problem. Shiva, I'll move on to you. The name of Shiva's company is Ankur Capital. They have been a pioneer in investing in deep tech, and especially in those sectors where investors, institutional investors or the funds were shy because they invest in technologies which give maybe return over a long period of time. So something on that journey, and where are you looking at the new ventures, please?
Sure. So just to quickly introduce Ankur, the name Ankur does come from us coming in early in a journey as the company is sprouting out. So we come in at a seed, pre-series A stage, normally first investor that's going into a startup. And the focus for us is in 3 themes: agri, climate, and looking at solutions being built for Indian masses or the global south as the larger opportunity will be. For us, the focus has been, especially for the last few years, on saying what are the deep science-based innovations and digital models as well, but what are the deep science-based innovations that are coming in these avenues that can revolutionize the industries they're in. So for us, what that has meant is looking at companies that have been riding tailwinds of things like bioinformatics changing. AI is something that we've seen from different elements in the last 6-8 months of how transformation has taken place. But these are winds that have been building up over time, and you can see there's a different set of technology solutions that can now be built that were not possible 3-4 years ago. So for us, as we're taking on a new theme, the question of why now has always been a critical element. When it comes to deep science startups more generally, we're looking across the biotech space, looking at energy-based solutions that can enter new avenues and look at industries and changes very differently based on how climate priorities now seem to be some front and center from a de-risking perspective that a corporate has to manage with as well. So we're looking at a range of those avenues that are honestly taking on the tailwinds that we don't think about day-to-day as business operators normally, but the Indian government has been investing in BIRAC, which is a biotech initiative for the last 10+ years now. You have a lot of this capital and innovation that was taking place and has been bubbling under the surface that you're now seeing, similar to what generally in the agtech space as well that Jinesh said. The first 5-6 years, you're building that ecosystem, the entire series of the technologies to come through. And then you suddenly start to reap these non-linear rewards with a lot more talent and a lot more potential coming through. So for us, that's the exciting element that we're spending a lot more time looking at nowadays.
So, ladies and gentlemen, if you have an idea and it has, you feel it has a long-term potential and it is deep tech, and so the right person who can invest patient capital is Shiva Kumar. So you have Shiv Shankar, you have to find him after the session. With that, I want to move on to Emmanuel. Emmanuel he's investment director of Caspian Fund. They've invested close to 500 to 600 CR in about 100 companies. So his model is a bit different. They come in the companies as mezzanine debt, how he invests, and in what kind of solutions he's looking at, he's going to tell us. And debt fund is slightly different than the other investment. Emmanuel, please, over to you.
Thank you, Sudhakar. So Caspian is more famously known for the debt funding that it does. So companies that get funded with equity require working capital to grow their business, so to scale it up. And conventional lenders, they cannot meet the requirements of a typical bank or a lending institution. That is where we come in and we help businesses of this nature grow. So that is one side of business we do. We've done close to around 50 agri startups in the debt space. Around 30 are active. Some of them have exited, grown beyond, some of them fallen by the wayside also. Simultaneously, we also have an equity fund which is uniquely placed, which is looking at upstream agri startups. So Indian agriculture is ripe for innovation and disruption. And the upstream is a space which is, in our view, under-invested. And we're looking at those opportunities right now from the equity side. Also, I think the unique thing about us is that we don't look at everything from an investor lens. So if there are startups who are in an early stage, who require support, who need mentoring, we invest a considerable amount of professional time in supporting early stage businesses beyond just investing. So that is a unique three-way approach that we have towards building the sector.
Thank you, Emmanuel. I'll come back to you for a follow-up question at the cost of the fund. I think our audience would like to know that. I would like to now speak to Agam Khare, who's the CEO and the founder of Absolute Group, so to say. A very cutting-edge technology, biosciences company, which is doing now very meaningful work in supply chain management of the commodities and bringing a new, for want of any better word, a new disruption or a new twist to the traditional supply chain management, which otherwise was known as trading, Aratiya Kakam. So Agam has worked very closely with our late President APJ Kalam Saab on a moonshot innovation, what I remember. So a little bit about yourself, about Absolute, and what innovative solutions you're bringing to trading of commodities.
Thanks, Sudhakar. So yeah, of course, I started my career working with Dr. Kalam. I was working on his Vision 2020 program. But fast forward today, Absolute is a biotech company. We have interests in agriculture, healthcare, and biomaterial space. Agriculture is large for us. Agriculture, we do everything from R&D and creating novel biologics molecules to then making biologics farm inputs from crop fertilizers, pesticides to stimulants, all biologics in nature. Then we go to the value chain where we do everything from crop insurance to financing to soil testing and advising growers in different conditions of growing. So very deep value chain engagement with all sorts of growers across the world. And then we also have a business in trades of commodities once they are grown. And that business headquartered out of UAE. What we do there, what we realized, I mean, I was hearing some of the panelists talk about the situation in India and how the market should shape up. I see clearly 2 or 3 areas which will open up the diaspora for India completely. The infrastructure that is being built right now as we speak, I mean the ports that are coming up, I'm aware of some of the ports that are being built. Over the next 3 to 5 years as they come up and take shape, with the available infrastructure, there is going to be suddenly the trade numbers that the country today is sort of dealing in are going to go up. And so anybody building, therefore, tracking it, sort of pulling it towards the back end, the production side, will certainly have an advantage. The other is the changing need of the markets. Like today, you're looking at ethanol production, biofuels. And so some of those crops are going to be of extreme importance, and some of them are today, but the nature of those crops are going to change very quickly. So today you might use a crop for biofuel and tomorrow that crop might change. So looking at which are those latent crops and looking at the entire process and then realizing which other crops are today latent in nature which can become large tomorrow, I think there is a massive business potential waiting to be built there. And third is the changing geopolitical diaspora. As somebody was saying that in this environment of becoming more self-sufficient, I think what we more need is regional self-sufficiency rather than individual self-sufficiency of the country, because it looks very beautiful to talk about self-sufficiency of a country, but given the climatic factors and agroclimatic conditions that each country has, there is only so much that you can do unless you can control everything, which does not look likely over the next 5, 7, 10 years. So given that, regional sufficiency will become very important, and therefore when we are looking at commodities, keeping a view of which regions, which commodities, today they may not be happening, but maybe tomorrow those commodities may come up. And so taking a little long-term view on things may create a whole new market that could open up. Also on the trading side, since there are a lot of traders here who are trading commodities, as you start, I mean, so trading, for one, is we are taking a very short-term view, an year view or a seasonal view. But as soon as you start taking a long-term view, 3 to 5 year view, it's like a stock market. You have two ways to trade. You can take short-term views, you can take a long-term view. But if you take a long-term view, then you start going back to the growers. There is, for instance, some oil. India has scarcity of oil. So what oil can you get in which can be done in India or regionally, which can then create a market throughput here? Those are some of the areas, I think, if people start going towards the back end and start linking those need versus what can be built, I think large markets can come out. And that is something that Silk Road, our business, which basically is into commodity trade headquartered in UAE, that business is taking a long-term view on. And so if any of you are interested to talk about it, we'll be very happy to chat about it.
Thank you, Agam. Now I would like to talk to Deepak Pareek, who is a walking, talking encyclopedia from seed to space, soil to oil. So tell us, what is your take on this funding scenario which we are saying? Of course, there's a lot of enthusiasm, there is a lot of froth, a lot of investment has been done. What is your take on this funding? Winter is wrong, but I think funding, little bit stormy weather, and what do you think, when will it get cleared?
Thank you, Sudhakar bhai. So actually, luckily, I had opportunity of being an AgTech entrepreneur, 2 successful exit, 1 failure, co-founded a venture capital firm. Now currently I like to call myself agriculture economist, because after doing all those things, you do gain some knowledge about the sector. And many of you who have been already trading would have been seeing me on CNBC talking about pulses. So that is also like, part-time activity I do. Now, this is very interesting topic when we talk about like, the funding winter. See, we have to understand, like, as Jinesh rightly pointed out, that actually this is a new sector. In 2012, actually, like, this is where I believe, like, in fact, it was even talked about that AgTech as a sector. And post-COVID, actually, there was a FOMO. Everybody thought, like, if we are not in this sector, we have not invested in this sector. So that's why you find sovereign fund, insurance companies, right, HNIs, everybody wanted to, like, have a pie of it. And that led to, like, sometime you started following the matrices which are not actually, like, helping the sector. And that's why a lot of fund came in, and now people become restless, like when you invest in other typical sectors where we have this mindset of 3-6-9. 3 months a pilot, 6 months test the market, 9 months scale up or close down. No, agriculture, one season itself is 6 months. Now suddenly those investors started becoming like a little bit jittery that actually, hey, have I put the money in the wrong direction or wrong sector? And this is why you see that, like, while there is a funding winter across all the sector, it is more seen in agriculture because, like, the challenges are a little bit more because of variability of the sector. A bad monsoon, like, would have cyclic effect actually on how the investment happens in the grassroots IoT company, which might be just putting sensors actually for irrigation. Now, my take is that, first of all, we are sitting in a country which definitely is having humongous scope in agriculture for a very simple reason. We have made our agriculture very inefficient. Now, whenever there is inefficiency, technology plays a very important role and innovation plays far bigger role, right, in removing those inefficiencies. And this is where I believe, like, India gives a huge opportunity. If we go a little bit broader, I believe India is a part of Asia, and you'll be surprised to know that out of the 7,000 odd startups globally in AgTech, 3,000 of them happens to be India, China, Indonesia, and rest of Asia. So Asia itself is having a humongous opportunity. Even if you go by the funding part of it, we are getting there. Out of $10 billion last year, which were invested in tech companies, definitely lion's share went to US for obvious reason, they are more mature market. But a substantial part of the remaining, in fact, 80% of the remaining money which didn't went to US, actually was invested in China, India, and Indonesia. And this is where I believe, like, going forward, there is a humongous opportunity. Second, as a startup ecosystem, we focus too much on some of the things which were low-hanging fruit, which is obvious for any young sector. But now we are seeing, like, for example, Agam is on the panel and he's like, talking about deep tech, whether it is biotech or digitization. Now, suddenly we have started realizing that actually, like, the unlocking of real potential happens when you invest in deep tech. And suddenly from GMVs, we started looking at it is okay to invest in deep tech companies which actually might not be having revenues for 3 years, 4 years, that is fine. But they are really innovating, and they're innovating in a way where they will create a big differentiator going forward. Second, again, the type of companies which are getting funded are those companies actually which are having more focus on GM rather than GMVs. So suddenly the gross margins has become, and Emmanuel would definitely second me, that they have been always looking at, like, show me the GM first, then we'll talk about the GMV. And for example, company like, Star Agri, right, when they started creating that GM, suddenly they see that there is a lot of investor interest, right? 2017, maybe that was not flavor of the town. In 2023, GM is the flavor of town. So I believe, like, the good companies which either are innovating at, like, the deep tech part of it, or those companies which have already have substantial size, but now started looking very closely that whether they are able to generate the margins or not, they would get funded. And going forward, I believe, like, definitely last year was not great. From 1.6, like, we come to close to, like, 400, 500 odd million. I think 24, 25, and 26 would again see those level of traction. But this time, I believe, like, all the investors are a little bit smarter, and they'll only put their bet when they are 100% sure.
So GM as in gross margin, not in General Motors. So from GM, we have gross GMV, gross merchandise value. I'm learning all these things since a few years. I realized that negative margin is loss, run rate, and GMV is simply turnover, and optimization of supply chain management is simply trading, which we have been doing for a long time. So there is definitely more focus from GMV to gross margin, EBITDA positive companies, and people are really looking to those companies which are not only unicorns, unicorn, tunicorns, to profit cons. So business is to make money. So investing community is conscious of this new reality. With this, I would like to ask Emmanuel, when you invest in a company, so obviously it's going like a mezzanine debt. So what kind of interest rate, for want of any better word, or coupon you charge, which is justified and which you have seen a good return as well? What kind of interest or rate of interest or profit rate or coupon rate?
Okay. I think we don't have much choice in fixing interest rates. For a non-banking finance company, interest rate is a function of cost of funds, your OPEX, and the risk cost. So adding these three together, in the market today, you would be pricing at 15 plus. That would be where you can't go below that because you don't get low cost funds. It could go down if the banking system lends to you, but it lends very little to this sector. So we are looking at businesses because as the discussion goes, only a company which is making gross margins can service debt. So we are looking at companies which have a margin of 20 to 30%, typically. That's the kind of margins at which this kind of a debt can be serviced, and which can grow without continuously diluting their ownership. So as they grow with debt, the company's value increases, and the ownership remains with the promoters to a larger extent. And these can scale very quickly. The whole idea of a company like ours is to walk with them for about 5 years, by which time they become attractive for mainstream lenders to pick them up. And that is where we reduce our loan by the time that they've grown, so they need us also. But a large portion of their debt comes from commercial banks and others, which could be as low as 8%. If it's export, it could be 6%. So your cost of debt comes down. So companies which are intrinsically profitable, have a business that can scale, but do not have collaterals and guarantees to offer, are the ideal ones that we pick up. Cost of funds is anyway starting 15, going to 18 or 19. Beyond that, we see, beyond 19 is high risk lending, so we don't indulge in that.
And what happens to this loan? Do you convert it into equity or get paid back? How does that happen?
Majority of the debt that we hold is pure debt. We really don't convert it. Very occasionally we do that. But we look at who's the other investors in these businesses. So really we're not going into proprietary concerns, or we see wherever we see funds and others who understand the industry, who have done their own due diligence, who see these as long-term, where they can bring in further rounds of capital. That is where we invest. So these may be profitable at the gross level, but still making losses. And we take a bet on such businesses. So almost 80% of the portfolio we have may be loss-making companies at a net level, but are making margins sufficient to service debt.
And do you have any history of converting this debt into some kind of equity at a discount at some point of time?
We do. If there are some cases to bring down the cost of debt, we could have a equity portion also in it. In some cases where a company gets into difficulties, there may be opportunities for us to convert. At that point of time, we could take a call so as to be reducing their cash outgo and to be able to increase the runway of the company. There have been occasions, opportunities we cashed into and opportunities we missed also.
Thank you very much, Emmanuel. It's very interesting to note that his funding is to those companies who might not be able to offer any collateral, and they might be even making loss. As long as they are profitable at the operational level and they see a business case, Emmanuel is the person for you guys to contact. With that, I want to move to Jinesh. You have been in the industry for a long time in investment space. And I think, if not mistaken, you have started as Omnivore started about 12, 13 years back. 3 series of funds. If you were to go back 5, 6 years down the line or 10 years down the line, what would be a couple of things would you like to change in your investment strategy? Where you think you would have put in more weightage? Where you think you would have avoided the investments?
I think the first would be like I would have started my fund 5 years later, right? I would wait for geo launch to happen in the rural market, because that was the time where everything started moving fast, right? So one, I would wait the timing. I would try to change the timing, right? Unfortunately, we couldn't do that. Second, I think we came too early. I mean, we did not have many co-investors together. So in the first fund, we took an average of 3 years and 4 months for any companies to get a follow-on investments. Today, fortunately, because of the ecosystem development, we could raise capital in 12 months and worst case 18 months from the time we invest as a follow-on rounds. So that I would wait, more and more investors are coming in. And I think we would prefer to work with the global investors because I think global investors understand the value of technology, what is being created, understand the value of the cost structures, what India is creating, understands that if they are able to leverage the Indian technology and focus on the global markets, I think it could be a very different scenario, right? I mean, a simple example, when you go to Israel or a US, everyone talks about creating 99% efficiency or 99.5 or 99, closer towards 100, right? Well, in India, I mean, our farmers, our stakeholders probably are working at 50 or 60% of the capacity. So no one's looking at 99% capacity. So intent is that, can you make it 80-85% capacity, keep the cost structures as low as possible, test it with the Indian stakeholders, And if you're getting it right for Indian stakeholders at the Indian price point, the Indian conditions, selling in the global markets in Latin America, in the African continent, Southeast Asia is a piece of cakewalk, right? That's what we look around it. And India has unique opportunities, right? I mean, we all talk about things like oil here, but if you look at the agri sector, I think dairy is the biggest crop in the country. Around 25% of world milk production happens in Indian markets. And that's what we use, right? So there is a lot of, I mean, we obviously use dairy as it, but there are a lot of biological benefits we have it. We use the biogases, we can create a lot of things. So that is what we look around it. So if I had a chance, I would have taken more bets in the dairy sector than what I would have done. That's what would be my three things.
Shiva, a little bit from you because you're in deep tech science. What are you doing transformational for climate smart technologies? Because that's one big issue, the global agriculture, especially even in oil seeds and especially in a country like India, which is somewhat food sufficient, but going forward there could be serious challenges. So what is happening in that sector?
Yeah, so there's a range of different startups that are doing different work there, but I thought one of the most interesting for this space is there's startups that are actually now looking at how you can look at research in areas where you have thematically new biostimulants, for example, getting manufactured. So one of our startups is a company called String Bio, which has actually looked at how you can use methane, which is organically existing from a lot of areas. How can you use that as a method to create biostimulants, to create alternate foods that can go into animal feed, go into human food eventually. But the biostimulant market just directly has applications of saying, here's where lots of our staple crops, they've done tests already in rice. You have a number of other use cases for most other plantation crops, etc., that can also start to step in of saying, here's a stimulant that is coming in naturally, organically existing, and can actually considerably lower your cost structure over existing crops. Those are the types of deep science innovations that are coming down the pipe. It's in a range of other climate smart solutions as well. But you have the opportunity that gets created from these of saying, fundamentally, the trend that is playing out of economics of saying the productivity is going to drop, the soil levels are not going to be able to be maintained, there's challenges of logistics, etc., that are there in the value chain, all of which, as some of the panelists pointed earlier, mean there isn't going to be a fundamental shift or anyways an increase in price trends. These are the types of technology solutions that can say, here's where there can be radical changes to the cost structure of operating several of these businesses. So it can happen on the digital models as well that are providing consulting input, and we were talking separately with some of the panelists about weather advisory, etc., that you get much more nuanced input that you could previously. But from a deep science perspective, these are the types of opportunities that are coming down the pipe that just can radically change operating cost structure.
Thank you, Shiva. Very nice. Agam, now you are sitting here wearing the hat of all the entrepreneurs, the young India, and I'm sure there are many people still left in the audience, that's why they're here. What would be your advice to the wider audience, and especially the entrepreneurs, when they go to an investment company or funder or financier? What will be your advice to them, how they should approach them, and what is something which they should definitely do and something which they should definitely avoid?
So I think, see, if you look at a little bit of history of how businesses were built, nobody really went to raise capital. They built business bootstrapped. So the only reason, in my view, you should raise is to speed up your process of where you want to get to, the end goal. Or it could be for strategic acquisitions and getting strategic capabilities. I don't, in my view, see any other reason. Of course, one could be deep R&D, which again falls into the capability window. I don't see any other strategic reason why you should need capital. And given the diaspora here, if you're looking to build in commodity space, I don't really see that there is upfront need of capital. I mean, there is business that can be built, but given, I mean, to answer your question, Sudhakar, if you have to go, I mean, the real thing that in my view, you should be very clear about what your end goal is. And I call that as infinite clarity, not good clarity, not decent clarity. Should have infinite amount of clarity about the subject that you are into. Very deep subject matter expertise, very deep insights into where are you going to be landing up over the next few years? What is that you're trying to build, and what is your right to win in that game? So I think 3 questions I tell everybody to answer within my team also is who and what are you up against? And when you start answering that, you actually get to understand what are the different models going around in the world and how can you really disrupt it. The second thing you should answer is what to play there for. What is the game you can play? And that comes out of your behavior and your capability as a team. And the third that you should answer is why should you win, how to win. And once you have answered all those three questions, I think you're pretty much in a good spot where you understand the business. Then look at the financial side of it. It should make good economic sense. People, talked about, with all respect, GM and GMV, but I think in my view, there is only one kind of money at home. And so eventually if a business is not generating profit, like the net profit, money at hand, the business is not business. We are still in our journey to create a business, and let's call it, therefore, startups till the while we reach there. And so the point is, I think what India needs to do is to really go forward, build real businesses, and have money in the bank. The only two things people should try to maximize is the value of the business and net margin, which is money at home. And if everybody tries to optimize for those two things and starts looking at the entire value chain. I mean, when we started, we looked at the entire agri value chain and we said, where is the money? So we looked at farm input space, we looked at fintech space in agri, and we said export. So those are the areas where historically people have made money. And so those are the value chains where you can extract some values. But the other value chains, when we looked at them, we figured out that there is hardly any money to be made. And you can't disrupt what's been running for like 50s of years unless you have some very deep thing that you bring to the table, and so I mean that's an individual thought process. It might be correct or wrong, basis your use case. But I think that's the fundamental. Have very deep clarity around the subject, where you want to land up. Have very deep sense of what your finances are going to look like, what capital are you going to need. And when you go to raise, never raise for an year because 12 months is a very short period. So probably 2-year, 3-year raise, I think that's a good spot to raise. Always start with small and then you can test out, pilot, and you can maneuver. It gives you a lot of advantage. And then get into the game, I think the battle, the final.
No, very, very nicely articulated that the objective behind raising money should be well thought out, and what kind of time frame you want to have with that money. Just don't raise money for the sake of raising money. Deepak, you have a very important announcement on which is we're going to announce now in terms of startup competition, which is going to culminate starting from here and it will go into January 2024. So I want you to tell the audience about that startup competition.
Yeah, sure. Before that, I'll just add on a couple of things, like, based on a discussion. So Jinesh very pertinently point about one sector, dairy sector. See, you'll be surprised that India is a land with 300 million cattle. Unfortunately, we are among, if you talk about top 5 producers, right, having the lowest productivity. Now, if you just improve efficiency by 20%, right, we would be the biggest supplier of the milk product, including SMF, to like ghees, to butters, to cheese, to rest of the world. And this is where I believe, like, the deep tech and right sort of technology. In fact, one of the company, I think your portfolio company is Talabs, right? They've been trying to do that. And this is, I believe, is very important. And secondly, I would like to second what Agam was talking about. In fact, the biologicals, right, the way that market is growing currently, and all of us, we all agree that actually we would like to have healthy food. And I strongly believe that going forward, there would be a lot of investment as well as, like, the market share increasing from currently between 5 to 8%, depending on which country you pick. I believe, like, it is going to become a high double digit in next 5 to 6 years. And there is a humongous opportunity there. Now, coming to what Sudhakar ji talked about. So guys, we are very excited that actually, like, we are looking at Global South, focusing on South Asia. And this is where actually we have planned a cohort of where actually, like, we have gonna be identifying some of those startups, which would be the post-revenue startups. And we'll go through multiple rounds and we'll seek help of some of the panelists sitting here to evaluate, judge them and see to it that out of those, we give opportunity to 10 startups to present virtually to this, like, awesome team. And out of that, we'll pick 5 of them who would be invited to Bangkok. Right, and so one more reason to be in Bangkok for them, right? And once like, they are there, they can present in front of not just the investors, some of the top investors from across the globe would be there, but also to people who are actually doing business in agriculture, who can be the typically rainmakers who give revenue. I always believe revenue is the cheapest way of raising capital. So this is also an opportunity for them to do that. And soon we'll be like, coming on our social media platforms and different mechanism to share that link where like, those startup can apply, share their pitch deck, a video, and then like, take it forward. And we are very excited that actually we would also have some reward plan for them, which would be cash reward as well. We are already talking to some corporates to help us in doing that, including some venture capital funds also who can like chip in. And let us find some 5 jewel from all across Asia. Definitely being Indian, we would be a little bit biased, I think, Sudhakarji. Floor to you, sir.
We have a QR code of that competition. If we can, if it's already loaded, if you can show on the screen. So you just take a photo of that and you'll have a link to that if it's there. I think it's with Vijay and Omkar there. But after that, since you have waited so patiently, of course you'll be rewarded with food, but you'll also get to ask some questions because I know you are holding on to your hunger. So we are happy to, if you have any questions, this is your chance to ask your questions to the best venture capital funds in the industry, best of the brands, entrepreneurs. If there is any question before we wrap up the session. Yes, and also Deepak has an important announcement. Soon he's going to launch his own channel, Seed to Space, which will cover everything from seeds to technology. And so beware all the journalists and channels, competition is coming. And I'll give the mic to Deepak to tell us a little bit about his channel.
So Seed to Space journey actually started on LinkedIn when I put up a newsletter, and I used to like, just put like, fortnightly, right, something little bit more detailed and elaborate. And in a year's time, like, I got more than 7,000 like, subscribers. And all of them, they keep on like, writing that actually like, reading such a long thing is a little bit difficult. Why don't you actually speak about it and collaborate with investors, entrepreneurs, and bring it up. And I did a small experiment on YouTube and it did pretty well with more than 1 million views and all that. So now actually like, we have put up a YouTube channel as well. Seed to Space is the handle, and Seed to Space is also a handle on LinkedIn, which is a newsletter. So please subscribe, and I'm pretty sure that actually like, you'll get a lot of insight and interesting aspect covering, as Sudhakar said, from seed all the way to space. Thank you.
And please do take a photo of this QR code. The event is also live. This will be put on the respective websites. And I'm encouraging all of you to share this with your respective networks, young adults, entrepreneurs, invite them to participate.